Hi, Assalamualaikum. My name is FATNIN KHALILAH binti IDHAM KHALIL. For this assignment, I want to present about topic 5, currency future and option. A derivative is a financial security with a value that relies upon or get its cost from charges in the underlying resources. A derivative is a contract between two or more parties in which the price of the underlying asset is determined by price movement. Stock, bond, commodities, currency, interest rate, and market meet the underlying asset for derivative. These assets are basically purchased via brokerage. Hedging, speculating, and arbitraging are all using through derivative. So, what is derivative? Derivative is a financial tools that help people control their risk and volatile market. Derivative also a monetary security with a value that is dependent upon or derived from an underlying asset or group of assets. Other than that, hedger, speculator, arbitrager, and margin traders is a participant in the derivative market. Option, future, and forward is a type of derivative contract. The value of derivative product is determined by the underlying instrument, which could be commodities, interest rate, or stock. Okay, now we will move on to the currency, future, and option. So, what is future and option? Future and option is a tools used by investor when trading in stock market, also used for two purpose, hedging and speculation. Other than that, future and option also is a contract or agreement to buy or to sell specific underlying asset at a specific future date. And for future, an agreement between two parties or to buy or to sell underlying instrument at settlement price at a certain time. Lastly, option is a contract negotiated between buyers and seller and have been standardized the specification of the contract and at the predetermined of the exercise price. Buyer has the right to use or not the option and only seller has to fulfill the agreement. As far as future contract go, there is only one primary type. However, there have more choices when it comes to option contract. There are two types of option contract, is a call option and put option. Call option is an option that gives right to the buyer or holder to buy the pre-specified currency at an exercise price. Put option is an option that gives right to the buyer or holder of the option to sell the pre-specified currency at an exercise price. Call and put option are used in different situations. A call option is preferred when the prices are expected to increase. A put option is often chosen when the prices are expected to fall. How future contract and option contract are used in speculating and hedging. Hedging in future contract. Hedging is a buying or selling future contract as a protection against the risk of loss due to changes prices in the cash market. Short hedge is a use when have planned on selling the product at a future date and want to protect self from falling prices. Long hedge are used when have a plan on buying commodity and want to protect against prices increasing. Future can be used to hedge the price movement of the underlying asset. Here, the goal is to prevent losses from potentially unfavorable price changes rather than to speculate it. Many companies that enter hedge are using or in many cases producing the underlying asset. For example, corn farmer can use future to lock in a specific price for selling their corn crop. By doing so, they reduce their risk and guarantee they will receive the fixed price. If the price of corn decreases, the farmer will have a gain on the hedge to offset losses from selling the corn at the market. With thus a gain and losses offsetting each other, the hedging effectively lock in a acceptable market price. Hedging with option is a hedging strategy used by investors to reduce their exposure, the risk in the event that an asset in their portfolio is subject to a sudden price decline. When a properly done hedging strategy reduces uncertainty and limit losses without significantly reducing the potential rate of return. Stocks are sold at a specific price within a specific time using a put option. Now is a future for speculation. A future contract allows a trader to speculate on the direction of movement a commodity price. If a trader bought a future contract and the price of the commodity rise and was trading above the original contract price at the expiration, then they will have a profit. Before expiration, the buy trade, the long position, would be offset or unwound with a sell trade or the same amount at the current price, effectively closing the long position. Short position is a chosen where the item will be sold and will buy back when the value declines. So now is option for speculation. Options are monetary derivatives that give the right to the holder to acquire or sell certain asset by a certain time at a given price. Speculation need to trader to take a place in the market betting that the price of a security or asset will be rise or decline. Speculators try to get a large profit, and other option to do is applying derivative that use large amount of leverage. This is where option come in operation. So this is different between future and option. Future, buyer obligated to honor contract, required higher margin payment than option, preferred by speculator and arbitrager, unlimited profit and loss potential. For option, no obligation on buyer to actual buy or sell, required a lower margin payment than future, preferred by hedges, unlimited profit, unlimited loss potential. So this is different between future and forward. For future, contract which the parties agree to exchange the asset for cash at the settlement price at a future date. For forward, an agreement between two or more parties that acquired to sell underlying asset at future date, rate or price. Transaction costs for future, brokerage fees for buy or sell order. For forward, based on a bid-ask spread. Delivery date. International Monetary Market (IMF) future currency are available for only few specific time per year available for delivery. For forward, bank offer forward contract that has been delivery at any time. For future, credit risk is low, but for forward, high risk as a one party may not fulfill the contract. So now we know something is about derivative and how future and option work in hedging and speculating. Derivatives are thought to improve the efficiency of financial market. In a conclusion, one can imitate the payout of asset by using derivative contract. As a result, in order to avoid arbitrage, the prices of the underlying asset and the corresponding derivative tend to be in equilibrium. When the investor utilize future contract as a part of hedging strategy, the purpose is to limit the risk of losing money due to a negative change in the market value of the underlying asset, which is typically securities or similar financial instrument. That's all from me. Thank you.